All right. Good morning, everyone. John Hutchinson and Jeff Wood from Traders Reserve with Wednesday, November the 5th, Breakfast Club, the White Slide edition. At least for me, I'm sure Jeff will have some fancy stuff for you on his slides.
You
But
know I only do white slides.
yeah, I didn't have time to fancy them up or pretty them up this morning. So um, I'm sure everybody heard the news yesterday. Goldman Sachs and Morgan Stanley are now freaked out about the valuations on Wall Street. Now, they seemed to be okay with it when the market was running at 22 and a half times forward earnings back in the beginning of the year. But oh boy, that next phase, boy, they're really worried now. Goldman Sachs projecting, potential for correction of 10 to 20%. Not sure which one, but apparently they needed a very wide range. Morgan Stanley, not to be outdone or underdone, a 10 to 15% correction. Okay. The cautionary tale here is be careful when big Wall Street banks and firms come out with their messaging because oftentimes they want to scare people out of the market so they can snap up companies at cheaper prices. I'm not suggesting that that is going to happen. I'm not suggesting that it's not going to happen, but I know that it is, it's self-serving when they come out with those kind of with those commentaries, saying, "Oh, well, now we're going to project a correction." Well, correction can happen at any time for any reason, but corrections are largely uh, economically um, driven, and there is there are some signs related to why the markets are weaker. Uh, One aspect of what's happening over the last week, really, since the Fed meeting, is the tech market coming back to the primary market, and we'll take a look at a couple of charts here in a minute to show you what I mean. Tech valuations have been extreme, and we all know that. But the underlying problem that still exists is there's too much money flowing into stocks, and it has to go somewhere. And it is not a surprise to me that most people, if they're investing, they're not investing in GM. They're going to invest in Apple, Amazon, Microsoft, Nvidia, even Palantir, right? They're going to put their money in the names that they're hearing about, whether it's on the news, whether it's on CNBC, whether it's through services that they buy, subscribe to, etc. They're going to buy the hot stocks. Uh, Now that is not a practice I suggest for you, and I think you're all smarter than that anyway. But there's still just too much money flowing into the market. But there is a legitimate case for a bottom up recession developing, which is when I say bottom up, I mean the lower end of the economic scale struggling. And eventually that bubbles up to the middle tiers of the economic scale. Uh, and that's when a recession actually would happen. And if that's going to occur, we will get, uh, I, I, I firmly believe that we will get advance warning from Black Friday weekend and Cyber Monday sales and Christmas sales. Use that as a guide, as a trigger for 2026, and be prepared next year to reduce position sizes, reduce capital in the market, hedge positions, hedge the market. If we see a pretty significant decline in Christmas sales, then that would be a warning to me. That tells me that the middle of the economic scale is cash strapped or credit stressed and not spending. Um, in which case that starts to lay the ground for a potential recession. Now, later this morning, we get the ISM services report. ISM manufacturing came in again in contraction. Uh, there were some there were some bright spots. This is the pig with lipstick edition of that report, but forward orders were higher uh, from the October report. So that's at least projecting a little bit of a move higher for manufacturing, and prices paid came down a little bit. So silver lining. But overall, manufacturing's been in a state of contraction for more than 2 years. So it's not the end of the market that's going to move things. Um, and the negative commentary is starting to become overkill. And at some point, that just further weighs on individual investors like you and me. Um, one, number one, we have seen a divergence, and if you attended the MTC event, you probably heard it a little bit, where Haley Bjorklund, registered financial advisor, is very bullish on the economy, on stocks, on the market, etc. But individual investors generally are not. They are more bearish. They're taking they take a dimmer view of the stock market than financial advisors do. I'll grab the report for you for next Monday, but there are a couple of tracking programs or services out there, excuse me, uh, that sort of assess the individual investor versus the financial advisor markets. And financial advisors have been trending bullish, but individual investors have been trending bearish. So that is a market divergence that exists, and the this constant drumbeat of negative, negative, negative doesn't help. Now, it doesn't have to all be positive. I'm not looking for Pollyanna here, but let's at least be realistic and honest about things. Where is the economy suddenly contracting? And does not seem to be the case. The numbers don't back that up. Um, are there are there stress fractures appearing in the economy? There certainly are, but unless or until they break, uh, we have to be cautious about um, excessive negative approaches. Yesterday, following the sell-off and all of the projections or predictions, whichever you prefer, from Morgan Stanley, Goldman Sachs, the bond market didn't move. And that's a key sign for me, because that suggests that the bond market is not worried about growth right now. If the bond market had spiked, if yields had spiked on the 10-year treasuries, that would have been the bond market agreeing with Goldman Sachs or Morgan Stanley's outlook. The fact that the yields moved 2 points, 0.2%, tells me that the bond market's not worried. Not at this point in time, not based on known information, known data. Is AI enthusiasm waning? And this is a key point. Naturally, we launch a service called AI2 right at the juncture of AI enthusiasm potentially waning. That's how it goes for us. Um, but I would say yes, yeah, to a degree, it is. The focus is too much on companies like Palantir, and we'll take a look at their chart here in just a little bit because they announced earnings. Uh, but the trend, for the most part, is still companies beating earnings, beating on revenue, and raising forward guidance. And that last point is the most important one. If they're raising forward guidance, that means that they have a much more a stronger view about their potential in the next quarter or the next fiscal year. So a number of companies have come out and done with the same approach, with the same commentary for their own earnings calls, raising forward guidance. That that tells us that there is demand. There may be supply issues, right? Supply catching up to demand. But Lumentum, which is a stock we're holding in the Momentum portfolio in the AI2 service, reported earnings. Their pre-market, they were up 15%. Same thing, beat on earnings, beat on revenue, excuse me, beat on EPS, beat on revenue, and raised forward guidance. So when you see the companies that are central to the AI story, the AI narrative, um, that's what you want to pay attention to. And we'll take a look at a couple of those here in a minute. Um, the last thing is what I'm starting to develop this right now. It's the AI problem for you as an individual. And this is old school, dating all the way back to Michael Schulman even. some of the things that he used to teach, which is think like an investor, not a consumer, when it comes to artificial intelligence. And the reason I say it that way or present it that way is there are things that the media is missing about the AI narrative and the AI story. And it is not, um, AI is not consumer ready right now. We're the true digital age transformation took over 30 years to become a multi-trillion-dollar industry. And that's everything from computers, even going deeper. That's everything from chips to computers, to digital media, apps, etc., retail. The entirety of the digital age transformation took 30 years. AI is in year two of expansion, or transformation. And as I stressed during the lead-in and during the AI2 summit, the lead-in to the summit in September, and during the actual summit itself, this is first and foremost a business transformation, not a consumer transformation. And the media is completely missing this. And recognize that CNBC wants to sell ads. So whether you make money or not, they don't care. But they're overlooking that this is not something. This is not a light switch. Companies are not just going to turn on AI. It's the same thing with with renewable energies. You don't just turn off oil and turn on solar. It doesn't happen that way. These transformations take decades. Now, as an investor, that can be hard, right? You may not have decades, and even if you do, you may not be that patient. But the rush to buy everything AI still has created a divergence in valuations, and the companies with extreme valuations like Palantir now have unrealistic earnings expectations attached to them. And companies like a Micron, which still is trading at around, I'll double check it in a minute here, but trading around an 11 PE forward, is severely undervalued with a long-term growth trajectory based on what they have available. The other part of this is, and the thing that the media isn't talking about is, AI can do multiple things, right? It can be for a company like a Lemonade, LMND is the stock symbol, right? They're a pure play artificial intelligence company in the insurance industry. I've mentioned them multiple times simply because it's an easy to understand approach to a pure AI company, right? You have an AI insurance agent and you have AI claims agent. They still have human involvement, but the front end of that business is AI driven. That's a pure play AI. Well, their operational costs are lower. Their ramp up costs may be higher from a technology position, right? Buying and building and developing. But the back end of that, the operational end of that, their costs are lower. And this is where that transformation starts to make more sense as an investor, which is, as companies begin to adopt and execute on artificial intelligence in their businesses, there are operational cost efficiencies. Well, where does that cost efficiency fall to? It falls to the bottom line, and that increases revenue and EPS in future years. But we're only in year two. Most companies are still in somewhere between stage one and stage two of discovery and adoption of artificial intelligence. Right? They don't know what those operational efficiencies are. They don't know what those speed to market possibilities are for them. So there is patience required, which the media never has, and Wall Street may not have. But Wall Street certainly does not want to pay extreme valuations, which I understand. But the more work that we do inside of the AI2 service, the more we'll start to look at which of the companies that can be traded or invested in have the right kind of mixture of valuations. Companies that are trading at a lower forward price to earnings ratio against higher future earnings. That's what I'm looking for. Those are the types of companies that I want to own because they have that potential. And if there are operational cost efficiencies that are gained, that simply adds to the bottom line. So I'm a little frustrated that in the previous 8 to 16 months, neither the media nor Wall Street had any problem running prices up. But now it's a problem. So excuse me for being angry about that. And mostly I'm angry for you because it puts multiple positions across the board or across the spectrum of trading at risk because Wall Street can't figure itself out. So let me pop over to the charts real quick. I want to show you a couple of things that you can do, um, things that we've talked about in the past, but I never know who's on here. So uh, this is one of the one of the best ways to gauge the S&P 500 versus the broader market, and that's the RSP. That's the Invesco S&P 500 Equal Weight ETF. And Jeff also uses one. I think it's the EUSA. Um, what this is, the difference here obviously is all of the stocks in the S&P 500 in this ETF are equal weighted in the ETF. So you're not getting the overweights of an Apple, of a Microsoft, of an Amazon, et cetera, as you do in the SPX or the S&P 500 or any ETF that tracks the S&P 500 as a weighted index. And what you really see is if you look really hard at the lines here, um, really since late July, the market has been sideways. The broader market has been sideways. So what this tells me is, and we already know this, but it validates that big tech has been leading the market higher, not the broader economy. And this is where the concerns begin to evolve for late fourth quarter, early first quarter, maybe second quarter 2026. If the broader market is not taking part in a rally like this or a bullish market, and instead is moving sideways, then that's telling us that those companies are not outperforming on revenue and earnings expectations. And if we were to go back and look at early earnings reports in the most recent quarter here in the October period, we would see that that's largely true. A greater number of non-tech, non-AI centric companies, not necessarily missing earnings, but underwhelming on revenue, underwhelming on earnings. So there's a weakness developing in the broader market across multiple sectors. That's everything from consumer discretionary to retail, restaurants, et cetera. And absent labor numbers temporarily, although private payrolls, I think I just saw the private payrolls report was plus 42,000. So that's a boost. That should be the ADP report. I have to double check the source on that one. Came off of my phone just like 10 seconds ago. Uh, Absent labor numbers from the government right now, is labor, or are we looking at a tariff plus labor problem? And if that is the problem, that explains why consumers are, or where consumers are withholding spending. Um, Talked recently about travel and other areas. So one of the things that this is one way that I want to keep my eye on the overall market. But let's go. Hang on. Let's try again. Take a look at Palantir, right? So a double drop following earnings. But if we go back and look to their earnings, where is it on the daily? Here it is. So they beat EPS by 25%. They surprised on revenue by 8%. They were even plus 62% on GAAP earnings, generally accepted accounting principle earnings, right? So that's beating across the board. But with a company that's trading at 195 times forward earnings and 400 times trailing 12 months earnings, that's what I mean by unrealistic expectations. I don't know what expectations Wall Street had for Palantir's earnings, but obviously that wasn't good enough. And they raised forward guidance. So this is the trend that I'm starting to see in companies that are very much overvalued. Here's a company, Lumentum Holdings. I mentioned we're holding this currently in the Momentum portfolio. But look at the forward price to earnings ratio, 29. And they just reported their earnings, and their earnings were an EPS of plus 6% and a revenue surprise of just 1.4%. And yet that stock is up 16% pre-market. Right? See, this is the valuation problem that we have, and that's why I stress we have to think like investors. We can't think like the typical retail investor. We have to look more at the underlying numbers that are driving the market, how they're driving the market. Where is the value in, even to me, in AI, in artificial intelligence? Another company that just reported earnings was Shopify. Um, didn't didn't take to their earnings, and they missed on EPS, but they increased on revenue. Stock was down. Now it's flat. We'll see if it moves up here. Um, Q4 described as inline. So they had a 32% revenue growth. AMD just came out with their earnings, but they were below margin, right? So now we're adding in new things. Well, their margins weren't high enough. Well, we look again here, 2% beat on EPS, 5% beat on revenue, and 8% on GAAP earnings. This is what I mean. This is where I think we're going to have a challenge in the not just this quarter, but in the next one, maybe 2 quarters, is what are Wall Street's real expectations? The Oracle had the same problem. They posted that massive earnings beat, a $30 billion customer. I mean, maybe, yeah, it was 30 billion. It was like a ridiculous. You look at Oracle's big move up from a little over a month ago, way back here, right? When they had that big announcement and all the way down. And when they announced earnings, or after they announced earnings, suddenly Wall Street was worried about Oracle's margins. Right? So maybe it's a matter of moving the goalpost, but those are some of the issues that are affecting individual stocks. But if you look at, and I know I keep talking about them, here's Micron. Micron up today, down yesterday with the overall market, but cheap. I mean, cheap. You're getting 11 times forward, you're paying 11 times forward earnings for a company with 5-year EPS of 32%. That's a huge discount. And if they hit their revenue numbers, and you take a look at their last quarter, revenue was flat. Earnings were above. Earnings were above on both top and bottom line. But if they start growing revenue, that price to earnings ratio is going to make this probably a better buy than a stock trading at $5 a share. Now, I have a vested interest in Micron because I have it as a recommendation. So take that as a grain of salt. But this is an example of, or these are examples of the types of companies that I'm looking for. Let me give you an example of a company that I am avoiding. If you're familiar with ARM Holdings, another semiconductor company, they're due to report earnings after the market closed today. But again, 72 times forward earnings for a company that's only going to grow its revenue 20%. That's upside down. That's paying way too much, even with higher than normal EPS growth. And they're in the semiconductor stock. And the other issue to me, just quickly looking at the chart, is you've got a declining RSI, right? You have this divergence here between relative strength and the actual movement in the stock. Stock making new highs here and here, but that not being confirmed by RSI in either of those two spikes. So there are cracks in the market. There are always cracks in the market. And I'm sorry for the long soapbox today, but anyway, it's a frustration for us as investors when Wall Street can't get its own story straight or shifts those goalposts. So, Jeff, I didn't leave you a lot of time, but you have plenty of time to share what you need to share and walk us through your ideas for the day.
Sure. All right, let's get to it. Let's do, see if this works. Hopefully you see my screen now. Yeah, so I just wanted to take a quick look since we looked at this on Monday. Hang on, why is Zoom being weird? Okay, since we looked at this on Monday, I wanted to kind of show you this again today. Obviously, with yesterday's big down move, we did have an over 100% down move on SPX. So, that's an outside of the normal sort of range move on SPX. And so when that happens, there tends to be a reversion to the mean. So things aren't all bad, um, even though you have these sort of big emotional days that we had yesterday. But one of the things I'm definitely looking at is, again, the difference, the summary of stocks with new highs, new lows, and that across the board. And specifically for market breadth, I'm looking at the 5-day. And I want to really start seeing some stocks hit 5-day highs versus 5-day lows. But when we have $2,500 stocks hitting new 5-day lows versus only 500 hitting new 5-day highs, again, that's getting to some of those extreme levels. And if you watch this metric long enough, again, this doesn't mean that today's going to be a reversal day. It doesn't mean that all of a sudden everything is going to change or anything else. But if you sort of missed yesterday to the downside, you just have to be a little bit careful because we are getting to, pulling that rubber band a little bit, maybe too far to the other way. And again, now we might reverse up for a day or two and then continue moving lower. I'm not predicting prices in the next 2 weeks or a month or anything like that. I'm just saying we still have a bearish breadth in the market, but this is getting to sort of that sort of extreme level of bearishness within new highs and new lows. Okay, so moving on. So when you have a situation like this and the market moves up whatever it is 70% of the time over history, it's no surprise I don't tend to do too many bearish trades. Yes, you can make lots of money being bearish. My sister, happy birthday today. She's a perma bear. She loves being bearish and she's right like twice a year. But so I don't tend to be on the bear side. So I when days like yesterday happened or whatever, I tend to start looking for value in oversold sectors. And so we showed this on Monday. I just wanted to show this again, that the S&P 500 index, the number of stocks trading above the 20-day moving average, if it has a little red line, that means this actually lowered from Monday. So I think Monday we had 40% of the stocks trading above the 20-day moving average. Now we have 35%. Consumer discretionary down. Consumer staples stayed flat. That's why that's yellow. So we did actually have some sectors that are showing strength in over the last couple of days, and that would be financials, real estate, and utilities. So a little bit more on the defensive side of things, which is interesting for November. But we have sort of three sectors that are sort of emerging. And actually, if you look at utilities, what's interesting about utilities is this has been green on multiple columns. So, over 58% of the stocks trading above the 50-day moving average, 77 trading above the 100-day moving average. So again, utilities are pretty strong and have been pretty strong. When only 45% of stocks in the S&P are above the 100-day moving average, then maybe it's time to again sort of get into certain sectors and find value stocks versus just being bullish on the entire market. And then you can see financials over the 5-day moving average. So now this has actually gone up. We have a green color here. Almost 60% of the stocks in the financials are above their 5-day moving average. And so if you sort of think of this as a wave, you start having some green here that should extend into some green here, and so on. So you see financials 59%, real estate 52%, and utilities 52%. So we're starting to see some green in some of these sectors. So now the question is, okay, that's great. Talk about this all the time. What am I supposed to do with this? Give me a trade, whatever. So let's look at this and how that translates into gains, financials, consumer staples, healthcare, real estate, interesting utilities. Well, this is yesterday. Over the last 5 days, not much. So over the last 5 days, consumer discretionary is the only one that's actually edged out a positive move here. But financials only -1% versus -1.7% on the S&P 500. So financials are actually beating the market. I know that's not how people like to view it. When your account goes down, you don't like to say, well, it didn't go down as much as the S&P, so I'm ahead. But you kind of have to start thinking that way. So if you look at financial stocks, I sorted them by 5-day percent change. So it depends on your school of thought. You can either be a momentum trader saying, hey, I want, when the market is sliding, I want to be in the best stocks in the best sector. And so if you want to do that, then I would encourage you take the financial sector, take whatever scanning tool you have, and sort by whether it's 5-day change. I mean, the market in November just started. We've only had 2 trading days in November. So you can do a 2-day change, you can do a 5-day change, whatever you want to do, trying to look for kind of like what's moving in the beginning of the month. And within the financial sectors, you have the CBOE, which I don't love trading a financial index, but or yeah, anyway. But you have Apollo, what was the other one? Chubb, Prudential, Travelers Companies. There's some big names here, Interactive Brokers, Allstate, Aflac, whatever. Even JP Morgan down here, Berkshire, even with Buffett, soon to retire, Berkshire's still edging a slight gain. So if you're a momentum trader and you say, hey, financial stocks are leading the way, they're one of the strongest sectors right now with the rest of the market pulling back, and you want to find the best of the best, then you would look at this list. And then, if you want to just buy stock, buy stock. If you are a income trader, then you start looking at the individual option scans within this sort of watch list. And again, I just pulled financial stocks just because I didn't want to bore you with all the different sectors. I just wanted to kind of show you one of the ways that you can look through all of this. But you can use you can create a watch list of financials, real estate, and utilities, and then do the same thing, sort those by 5-day change, and then kind of go from there. The other thing that you can do is if you're more of a pullback trader, and you're looking for oversold stocks within a strong sector, then what I did was I added the 2-day RSI to say, hey, what are some really extremely sold off stocks? And I was looking for, sort of under 10. And the thing that you have to worry about with any sort of indicator when there's a range. So RSI is supposed to be bullish above 30 and, bearish about or overbought above 70 and all that sort of stuff. Stocks, RSI, all the indicators just use closing price. So if the closing price continues to go higher, I don't really care if the RSI is 70 or 80. It's going to continue to be above 70 or 80. There's never a time where just because it touches 80, it immediately flips and then retreats. You can look at any indicator where it has those ranges and say, oh, well, as soon as it's above 70, that's overbought. I want to sell, I want to sell now. And you can look at them, and there's plenty of times where it's over 70 and stays over 70. So just because this is under 10 doesn't necessarily mean that these are going to start reversing higher. I mean, Fiserv or whatever is down 48% in 5 days. I don't care what the RSI is. I'm not touching that one. Maybe that's so deeply oversold, and maybe I'm going to miss out on a good opportunity. I have no idea. But even if I was a pullback trader, I'm not touching that one. What's that?
There's usually a reason.
Yeah, exactly. They're right. So, full disclosure here, I'm not as much of a pullback trader. I tend to be more of a momentum trader, but I wanted to show you, I actually I pulled up a chart, and I was kind of going through this morning, and US US Bank Corp, I have their credit card, whatever. So I was just kind of looking at their chart. And it's in, I don't have it here, but it's in a bit of a wedging pattern. And so, yeah, it's been down. It's been beaten up over the last couple of days. It's really been, it's down about 2%. So what I would say is, it's in that wedging pattern. If it breaks to the high side, then sure, then this is a overbeaten stock and it's breaking out to the high side, and great. However, this could continue to go down. So you just have to be a little bit more cautious, I think, on pullbacks. Um, of course, the argument for momentum is, why would I get in if it's already gone up? But we tend to spend more time with things that are already moving up than picking exact bottoms. But anyway, so I wanted to show you two different ways that even though the rest of the market, might have not looked too good yesterday, you can still find some gems within certain sectors, and this is how I do my scanning to find some of those. Now, we talked about this on Monday using Hutchinson. This is the S&P 500, using Hutchinson candles to sort of help smooth out the trend a little bit. And I did put on a Fibonacci retracement. And so we tend to say that the trend is still in play as long as you go from one impulse move low to high. And if we can stay above a 61% retracement, meaning it's allowed to pull back into this 50% area, it's even allowed to be, just above this 61% area. But if we give up over 61% of this move higher, then that's when we start saying, hey, the trend is breaking down. So it may not feel like having a big red day like this still means that we're in a bullish trend, but we haven't broken through that 61% retracement of this impulse move higher. And actually, there's quite a number of reversals that happen at 50%. And so, depending on where you draw your lines, on a Hutchinson candle, I tend to draw them from the bodies than the wicks, just because of how Hutchinson candles are derived. But we're seeing 67.57, 67.60-ish sort of as a level of potential support. So again, now we have market breadth of the number of new lows being a little stretched. We have coming into a potential 50% retracement. So that's a potential support zone. The Qs were at about a 38% retracement. And we've only had one real red Hutchinson candle, so we're not even in like a red Hutchinson zone. I want at least two red Hutchinson candles to say that we're pulling back. So this is just one sort of bad day. So again, not as bad necessarily, as it might seem. The other one, just because John was talking about this. And so I quickly, as he was talking, I quickly went over to CNN Fear Index, and we are at we're at extreme fear. And so I was like, well, okay, interesting. How good do investors do at being fearful, when the market is going up? And we tend to be at extreme greed at market highs, and we tend to be at extreme fear at market lows. And so I then just took this and said, okay, here on the top side is the extreme, or is the fear index with, I know it's a little bit hard to see, but this line where my cursor is going is the extreme fear line. And then the extreme greed line is way up here. And so when we dip into this extreme fear line, it tends to, no, I get you, like this isn't a great move higher, but it was at least moving sideways. At least, it didn't go down. We dipped into this extreme fear line March and April of this year. There was all sorts of Doge news. That was when we really started having the tariff talks. And so, yeah, we had a little bit of a rebound, but for the most part, investors were kind of right in this phase to be a little bit more fearful because, then we had that big drop once all the tariffs were announced. But the lowest low of the extreme fear index, the CNN extreme or fear index, the lowest of that low, which happened in April, is actually corresponds to the low that we had in the market, and then we moved higher. And then what was interesting is really since July, the CNN fear index went from extreme greed and started phasing out as investors started getting a little bit more fearful. And so the fear index started really dropping as the market continued to move higher. So there was a divergence there. We hit another just after mid-October, we hit another extreme fear level, and the market then, that was after that big Friday, October 10th, and the market took off and ultimately went higher. And here we are. We dropped very suddenly over the last couple of days, and now we are at extreme fear levels again. So, I'm not saying it's a perfect indicator. I'm just saying that when investors tend to get overly fearful, we tend to have a rebound. So if you start putting all these things together, you have the 5-day market breadth a little too stretched. You have most of these sectors trading with very few stocks trading above their 20-day moving average. That is historically a time where we start saying, hey, things are a little bit oversold. When there's 20% or less of stocks within a certain sector trading above their 20-day moving average. So not saying go out and bet the farm and go big and whatever else. I still think we're in a very, very cautious phase right now. But let's just take us. But sometimes when we have a couple of days where we've moved down about 2% or so, or only 1.7% over the last 5 days, need to take a little bit of a step back and say, hey, is this all that bad? Or are we just sort of going through, when you had this type of market move from April to now, we haven't really had that many big down moves. And so you sort of get complacent and you say, man, we had this big down move yesterday or a couple of days ago. The market must be falling apart and everything's crashing or whatever else. And it's just, we've been sort of lucky really since end of April to now, where we haven't really had these uh, you know, corrections at all. Yeah, we haven't really had I mean, I think this is I don't know that we've even had a 5% correction or whatever. So you get a little complacent, and then you get extremely fearful just when the market has a bad day. But let's, take a step back and look at it in its totality. The other thing, just John mentioned, I look at EUSA, which is true, which is the USA equal weighted index. So it's taking a lot of different companies and looking, and then giving them all equal weights. And as John mentioned, similar on EUSA, which is the equal weight of the S&P 500. The overall market has actually been very flat. We are in what I would call an area of interest. It was an area of resistance before. It finally broke out of that resistance, created a new resistance area, and then every time we've poked back into this 100-ish area, that has been a reversal time. Not saying it's going to happen now. Certainly there was a couple of days back here where we dipped below, but we sort of moved higher immediately afterward. So again, I think we're in a very cautious area. I think this is a very important area. If you're a little bit more on the aggressive side, you start taking some of these things and say, hey, I think this is a good time to dip my toe back in and get a little bit long exposure on some of these sectors or on some of these stocks. If you're very cautious, I would say, hey, let's just wait until some of these things are confirmed. Let's wait for this to, start having some higher highs and get out of this area of interest, because maybe this is the time where it doesn't act as support and it breaks through, and then we're down to this previous level of 99-ish or 99 and a half on the EUSA. So just kind of depends on where you are, but I think there are some areas and some stocks that you can sort of dip your toes in and start looking on the long side. And I know we're 14 minutes over, but I am now done. So
Nobody's going anywhere. The market doesn't open for 15 minutes, and don't worry about it.
Yeah,
If
well,
you got more to share because I got another chart I want to share.
No, I'm good. So I'm going to send it back to you, actually. So.
All right. One last thing. So, in my white edition slides relative to artificial intelligence back at the top of the hour or the bottom of the half hour, whichever it was, I gave you conditions on the AI to the narrative, right? As it relates to earnings increasing, EPS, revenue, and forward guidance. And then I mentioned Lemonade. Well, guess who reported earnings this morning? Yeah, Lemonade. And what do we see? Beating revenue, beating EPS, raising full year guidance. These are the triggers. And oh, hey, it's up 16% pre market. And it also has been developing a solid uptrend. Actually, that uptrend kind of dates back to the April lows, but it's been a little more streaky in here. But these are the triggers. When you're looking at, or if you're looking at stocks with us in the AI2, these are the things that I'm focused on. Companies that have proper valuation to me. That means we're not seriously overpaying for shares like Palantir. The company has a trend developing in their earnings and their revenue. And if we look back at the prior quarters, uh, go back one quarter, they surprised by 24% here. They surprised by 2% on revenue here. Go back and quarter back, surprised on earnings, surprised on revenue, right? This is an earnings and revenue trend that is developing for this particular company. This doesn't mean go out and buy lemonade, right? It is whether or not we see this consistent message occurring from companies that are in the artificial intelligence space, either directly related or indirectly related, and and how does that translate into when to own the company, when to own shares of the company, and for how long, or how long into the future. Now, little caution, the company is currently not profitable, so they don't have uh, uh, price to earnings ratio or forward price to earnings ratio, but they're expected to grow earnings 40% in the next 5 years. That's a company you want to own. There's a good reason to own that company. They are growing their sales revenue. I don't know. I probably can't get instant on their financials, but if I look at the trend in their financials, right, this is their EPS trend is rising to zero. It means becoming more profitable. They're not there yet. I think that's on annual, right? That's on annual. If we look at, close that. Thank you. If we look at their quarterly earnings, right? Again, next 4 quarters are expected to be negative. If any of those quarters, here's the report today, their reported earnings 50 minus 51. So at any point in these forward quarters, if they suddenly turn positive, this is a company that has, or this is the type of company that has significant growth potential in their stock price. That everyone starts to pay attention to them. So anyway, wanted to finish with that because I just happened to take a look at the chart and saw that they were reporting earnings. And let's take a look at an opposite. Tempest is another company. I got to move this for myself. Hold on a second. There we go. Try again. Tempest is in the healthcare AI sector. Um, they reported earnings, revenue up 85%, raised guidance forward. Again, the consistency of these types of messages occurring. So they beat on the top line, they missed on the bottom line by whatever that is, 0.004, right? But their revenue was up almost 2% over expected. So this is, and yet this is a stock that's going to open lower, move higher. They're below their 50-day moving average. It's also not a profitable company, but with substantial earnings potential growth. And one of the things that I talked about with AI2 members is you look at this difference between their market cap over on the far left side, their market cap and their enterprise value. Their enterprise value is higher than their market cap because the company is consistently reinvesting capital into the future development of the services that they provide, and where they have a competitive advantage in the AI space is in oncology and genomics, which allows their system to create customized um, customized care plans for cancer patients based on their genetic makeup, uh, and what type of cancer they have. Obviously, I mean that is a significant advance in healthcare intelligence that think of it this way: they're bringing together data from years of research and treatments and drugs, etc. And AI is filtering all of that down based on what's worked and then creating personalized healthcare treatment plans for cancer patients. A doctor can't do that, right? An individual doctor, there's no chance that they can pull that together. Doesn't mean doctors are can't treat, but they can't take that breadth of information and scale it down. So there's a justification for why I like this particular company because of their positioning. And right now, I mean, Wall Street may not like the company, and that's okay. I can understand. I might be wrong in the short term, but their earnings are justifying their growth, and their reinvestment in the company is justifying their belief. And raising forward guidance is telling you that they believe that they are growing their business. You don't raise guidance if you think you're not growing your business. So this is the trend to watch for in artificial intelligence companies. Are they raising that forward guidance? Are they beating estimates on EPS and on revenue? So I know I'm beating a dead horse for everybody. I apologize for that. But a couple more companies that we've talked about at length in the AI space and how their earnings have played out as it stands today. So that'll do it for today's Wednesday, very long-winded edition of the Breakfast Club. So you have Millionaires Trading Club at 10:30 this morning, Income Masters at 11:30, and we will be back with Breakfast Club next Monday at 8:30 a.m. Eastern Time. Hope everyone has a great day. Hang in there. I know times are tough. I know it's frustrating when the market backs up, but just be patient. Things, remember, good luck, bad luck, no luck. It'll all balance out. We'll be on the right side of things in very soon. So with that, thanks, Jeff, and everyone else for joining us. We will see you again very soon.